Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. And today I just wanted to kind of go over with you really quick why, again, a couple more reasons why we're not in a crash scenario right now, in a housing crash scenario. We are not seeing that unless something really dramatic happens and shifts with a couple of these things. Let me just share my screen with you real quick and explain what I'm talking about. So if we look at the inventory between, and this is nationwide, we had at the peak of the crash, we had 3.8 million homes for sale, over 3.1 or 3.8 million homes for sale. Currently, we have about 1.25. Some estimates are as high as 1.4, but the household formations are, much more than that. We're seeing 1.7 million in household formations. So when you look at currently where we're at, even if you take the higher number, 1.4, and there's about 100,000 homes a year destroyed, fire, or just destroyed in general. We're about even conservatively, we're about 2 to 3 thousand homes off, 2 to 300,000 homes off at least on that number. So back then we had these poor lending practices come into play, which led to the crash because there was an overabundance of inventory, which we don't have now. In the Phoenix area, for instance, Phoenix metro area, we had during the crash, we had like 56,000 homes for sale. Okay. 56,000. And remember how, I don't know if you remember, driving around, you see all these homes that were, being built in these new home communities, and they just stopped building them. And then maybe a few years later, another builder would come in eventually and build on that back, maybe in like, 2011, 2012, 2013. But even now, there's certain areas of town where you can see this. For instance, maybe in Buckeye, where you can see where they overbuilt and they just never rebuilt those properties. So this is something that led to the crash because we had way too much inventory for people, and this was across the country, and this led to, well, we got to unload these homes somehow, so let's create these poor lending practices. And it got to a point, like if you watch The Big Short, people were buying 1, 2, 3 homes that maybe didn't even have any business buying one home. So, this led to poor lending practices to unload the homes, and then it led to the crash. So, we see this was the case then, but now, we have lower inventory, about, a third of the inventory we had back then. I mean, in the Phoenix area right now, just again, just checking this morning, we have like 15,000 homes for sale, just over 15,000 of all property types, not just single family homes, all property types, the 15,000 homes for sale. Well, back then, again, we had about 56,000 leading up to and at the peak. So if we look at, the lending controls and the standards for the mortgage credit availability index, this is an index that basically said, how much credit is being allowed, how easy is it to get a loan or a home loan. You can see back during the bubble, we were at a 900 on the index, or 868. Okay, 868.7. Now this was a chart brought out just a few months ago, and the lending practices haven't shifted really at all. We're still doing the same type of loans, even with the 3-2-1 buy downs and things like that, which really aren't very risky. Like some of the loans that we were dealing with back then, you still have to be able to qualify credit, and your work history has to be there, and W-2s and that sort of thing, so, or 1099s. So all that's in place, and your assets. Now we're down to 100 on the index, or 102, just as of September of last year. So guys, we're just not seeing, again, the main cause of the crash was super high inventory, whether we're talking about the Phoenix local or the across the country. We're just not seeing that. And people have a ton more equity now than they did then. Even with the slowdown and the hibernation in the market right now, that's kind of slowing things down. Just because interest rates more than doubled and prices went up, we're kind of seeing a correction in the market, a balance in the market, which is a good thing. But we're just kind of seeing more of a balanced market. Now, here in the Phoenix area overall, we're slightly into a seller's market, but nothing crazy like we had seen before. So it's really important that we kind of put these things into context so people understand what happened then, what's happening now, what is likely to happen in the near future, and what the data points are, and what the critical path is to understanding, hey, this is nothing at all from the inventory to the lending practices to the amount of equity people have, and the sort of market that we're in. It's just not even close, guys. So hope that helps. Hope that shines some light on why it is that we had the crash to begin with, and why it's nothing like it is now. And remember, that recession back then was obviously caused by the housing market itself. A recession that we're in now, or that we're probably heading into, again, the feds don't tell us we've been in a recession until basically 2 to 6 months on average after it happens. So guys, keep in mind that, we may already be in a recession, which, people kind of feel that way, that we're already in a recession. Keep in mind that, during a recession also, I'll get into this in another video, but, interest rates fall, usually housing, and I've got charts I'll show you on this, but usually housing does pretty well during most recessions. That other recession that was, due to the housing crash itself. But during recessions, interest rates fall. It's just kind of a cause and effect. Interest rates will fall, because inflation drives mortgage rates. So as the inflation rate falls, mortgage rates fall, just because people aren't spending as much or not borrowing as much during a recession. Okay. So it only stands to reason, if inflation drives mortgage rates, interest rates will fall. And we're going to see that, housing does pretty well when it's more affordable, because the interest rates, were over 7. Now they're, hovering around 6-ish, low 6s to mid 6s, depending on your credit and type of loan. Government loans may be even less. So it's really a big shift, big difference between then and now. And historically, what happens during a recession is just this, that housing actually does pretty well. So I'll go into that more in another video. Hope that helps a little bit to clarify a few things, though, on the then and now. And again, a lot of stuff you're going to see out there with it's doom and gloom, and it's going to crash. We've been hearing that for a decade now. Okay, you hear that on CNBC, NBC, Diane Olick, all these people on YouTube getting followers to follow them. They're kind of grabbing a data point here, grabbing a data point there, and just kind of making it in mountains into molehills that aren't there. One example would just be, foreclosures are up. Well, of course they're up, because for about a year and a half, whatever the exact time period was during the pandemic, there was a moratorium on foreclosures. There was forbearance, in other words. There was forbearance. So the numbers went down to like nothing. And then when that was lifted, of course, you're going to have some foreclosures. So if you go from nothing, to a little bit, the numbers have gone up. But that doesn't mean that, we're crashing. That's not what's happening. I made another video about where we are in foreclosures between, comparing them between now and back during the crash. And again, you'll see the chart is just, there's not even close, guys. So hope that helps. Talk to you guys soon. Thanks.